Hey guys, Joel Franklin, market analyst for YouTrading. In today's video, we've been taking a quick look across markets. I'm going to be giving you an update as to what's been going on this week. First thing I probably want to talk about is on Wednesday, we are seeing pretty decent pull lower in the US stock market. Now, we've more than erased the gains that we saw in the first part of the week. You can see the S&P 500 here is back down into the 3,950s. Once again, looks like it's going to be testing its 200-day moving average. The catalyst for this latest pullback, or the main catalyst anyway, was Microsoft earnings, the first of the big tech giants, and basically the outlook that they gave for their Azure cloud computing business, which is seen as one of their most important growth businesses for the future, wasn't good. They're warning that revenue growth is going to decelerate, and they were just warning in a general further slowdown in corporate software sales. Now, Microsoft, the reason why this is weighing on the market so much is Microsoft is seen as one of the tech companies that's less sensitive to a downturn in economic growth because its products, it's very much got a monopoly with a lot of the products that it's used, like Microsoft Word, Microsoft Excel, Microsoft PowerPoint, the general Microsoft Office. Businesses are very much wedded to that technology, which in the past has meant that Microsoft stock has been quite a bit of a safe haven, you could almost ask, out of the tech stocks that you could potentially own. So the fact that they're struggling, it's sending some alarm bells, it's triggering some selling, and the Nasdaq is doing even worse. You can see here. But let's just quickly have a look at the technicals for the S&P 500, because, depending on how you view things, they're potentially not good. Again, we're struggling, or we failed to get above this long-term downtrend. If we fall back below the 200-day moving average between now and the end of this week, then again, we will have failed to get above the 200-day moving average. This failure that we're currently seeing in this area, very much reminiscent of the failure that we saw back in December, could spell the beginning of a move towards these recent end of December lows, or even worse, if people start getting really pessimistic about the outlook for US company earnings growth as we move towards this expected US recession. Now, talking of the expected US recession, let's have a look at some of the US data that we had this week. On Tuesday, we had flash services PMI, and while it was a little bit better than expected, flash services and flash manufacturing still below 50, still in contractionary territory. Okay. So we've got GDP data for Q4 out on Thursday. That's expected to show continued growth. And then we got core PCE price index inflation data basically out on Friday. So those are going to be worth watching. But the general idea here is that the US is moving towards this recession, which is widely expected at this point. And stock markets are unsure as whether that's going to be a positive because, yes, you've got inflation coming rapidly under control. That is leading markets towards pricing a less aggressive outlook for the Fed, which is why you've been seeing, this is the 10-year yield that I've just got on the chart here. You've been seeing that pulling lower in the last couple of months. You're seeing the 2-year yield pulling lower as well. This one's more actually sensitive to Fed rate hike expectations, but it's still above 4%. And if you're talking about recession, you really want to see the 2-year yield dropping way down from where it currently is. That's a real sign of expectations for not just the Fed not doing as many hikes, but the Fed doing a lot of cuts. And when you start expecting that, that is when you can start seeing equities making big strides to the upside. Because yes, earnings growth expectations are weak, but valuations getting boosted by a lower discount rate. But we're not seeing that yet in markets. So, it's tough to say where stocks are going to be going. We could be seeing a bit of a grind to the sideways over the next couple of months as the data comes out on how much the US economy is slowing. Is it the recession is going to be bad as expected? Is the Fed going to start easing at some point? There's still a lot of uncertainties, which is basically why the S&P 500 doesn't want to break above this trend line here. But enough about the S&P 500 for now. Let's have a quick look at the Dixie, which, oh, that's the wrong Dixie. That is the correct Dixie. Continues to grind lower within the confines of this trend channel that we've been talking about for quite some time. Like I said before, it's not like the most well-defined trend channel. Let's get the proper line, not the arrow. But, you know, looks like we're heading lower within this trend channel because of the weakening US fundamentals, which today's Microsoft earnings encapsulate very, very well. Data out of the Eurozone has been pretty good or better than expected this week. So let's just jump back and have a look at that. You can see here that manufacturing in France, Germany, manufacturing in France and services in Germany both returned unexpectedly into expansion this month. So the Eurozone economy really doing better than expected, probably because the winter's been warmer and energy costs haven't been as bad as expected. But that's helping support euro dollar as well as dollar weakness that we've been talking about. So this continues to grind higher. In terms of other asset classes, have a quick look at gold, which, dollar's grinding lower. Gold continues to grind higher. I've been talking about buying a dip back towards 1880, but, maybe we're not going to see that dip in the foreseeable future if the dollar continues to weaken and if yields continue to fall. Finally, quick look at US oil or the WTI. We're talking a lot about weakening fundamentals in the US. Yes, Europe doing a little bit better than expected, China reopening, but the US is a key market. Oil is correlated to stocks. So this is why we're seeing oil struggling to push above this $82 per barrel resistance area. But for now, those other positive fundamentals keeping us supported above 80. But yeah, guys, in terms of the rest of the week, like I said, the main thing, US GDP, core PCI inflation. Anything else that's worth a mention? Yeah, I mean, if you're into trading the G10, like the Kiwi, the Aussie, and the Loonie, we had the BOC just hike interest rates again by 25 basis points, but now they're going to pause as they assess the outlook in wake of a very aggressive tightening cycle last year. And look at these upside inflation surprises in New Zealand and in Australia, which mean that their central banks might have to do a little bit more. But yeah, guys, that's pretty much it so far for this week. I hope you enjoyed the video. Hope you found it informative, and I'll see you all in the next one.